A lot of traders have been using fair value gaps completely wrong. And in this video, I want to discuss the trading strategy that I use that provides high probability trading setups. And I want to compare the strategy that I use with order flow to what a lot of traders use in candlestick terms of a fair value gap. Now, it didn't come to my attention until I posted a recent video about this strategy on my YouTube, where a lot of traders in the comments were saying this is just a different approach to fair value gaps. And it gave me the idea that if a lot of traders use this strategy, they're going to be able to pinpoint better trading opportunities and be able to get on the right side of the market more times than not. I'm going to go over 3 specific trades. One was a $14,000 profit. Another trade, I'm going to show you a live trading replay, which was a $16,000 profit. And I'm going to show you a third trade, which also was around a $16,000 profit using this strategy. I would recommend everybody to follow me on my Instagram. I'm going to post a link for this in the description below. It's a really good resource where I basically recap all my trades on a daily basis. And I post really good trading tips and tricks that I guarantee you're just not going to find anywhere else on the internet. The link for this is in the description below. You're really missing out if you don't follow it. Now, like I mentioned, I did not know what a fair value gap was until my comments were flooded with how the strategy that I've been using is similar to an ICT term that's called a fair value gap. So I did my research, I looked up what a fair value gap is, and all this looks for is just where the market rapidly moves up or down on a candlestick chart where there is no trading activity that has taken place. Now, this is very similar to the strategy that I use, which I call low volume nodes. Now, in this video, you're going to see a lot of similarities between the two, and it's safe to say that the market is an auction. So being able to read the volume and the order flow, which is what I'm going to show you, will just simply validate this strategy even better. And if you don't look at order flow, this is a very good indication to start looking at it to validate whatever strategy that you use, especially if you're using fair value gaps, because again, they're very similar. The low volume node strategy is 3 main points. Number 1 is identifying large buying or large selling volume. We can do that simply off of a candlestick chart or off of the order flow. On this candlestick chart, we can see here that there's some strong, aggressive green buying as the market is rallying, indicating there's a lot of buying pressure in the market as it's trying to move up. The second step is the most important, and this is where a lot of traders would draw a fair value gap, is just finding ranges where price did not transact much volume. And when we look at the order flow, which I'm going to show you in a couple of seconds here, the order flow is going to show not much volume at those specific prices, indicating a low volume node, which could be seen on the order flow. And then the whole idea and the basis of this is to wait for a pullback or a rally into these low volume nodes to gauge if those buyers or sellers are defending price. It's just a simple strategy to gauge large buyers or large sellers present in the market. And the reason why we know they're large buyers or large sellers is because there was not a lot of volume that was needed to lift the market. And this is why point number 2 is so important to this strategy. So showing this trade from March 7th, this was a 4.5 to 1 risk to reward ratio. I was risking around $3,000 for this trade to make a $14,000 profit off of 15 full-size E-mini contracts. Now, off this chart alone, without validating it using the order flow, this would be safe to say, and let me know in the comments if I'm wrong about this, if you use fair value gaps, this would be a fair value gap that a lot of ICT traders would mark simply off the fact that the market had a very strong move up and leaves a fair value gap, although I don't agree with calling it a gap because there's really not a gap on the charts. So if you're an ICT trader, if you use fair value gaps, let me know if this first trading setup right here would validate a fair value gap. The market aggressively moved up. We mark it from the portion of the wick down to the lower portion of that candle, and we look for price to retrace into this range. Now, using the order flow, this is why it's so important to validate it with order flow. I do not need a candlestick chart to validate this low volume node strategy. In fact, the low volume nodes come strictly and only from order flow. And that's the main difference between an order flow trader or a candlestick trader. Order flow traders will define this as a low volume node versus a candlestick trader who does not use order flow would just label this as a fair value gap. So looking at the order flow in this specific range, it's safe to say that at 57.49, which I'm going to highlight, is the start to where the low volume starts. Now, this is just a depth of market. I would recommend any order flow trader to use any volume profile, depth of market to kind of validate this, to learn and understand the structure of volume by price. It just shows volume at each price on the session. 57.49 is the start to where the volume is lower. The gray column of SVP is just a session volume profile of the total volume on that day at that specific price. So at 57.50 right here, there is 800 total volume. And if we were to compare the red volume of 465, this is aggressive selling, to the blue volume, which is aggressive buying, 465 and 335 would give us our total volume of 800. It just splits buy versus sell volume to total volume. So looking at this structure of the volume, 57.49 is the start of where this low volume kind of develops, and it goes all the way down here to the 42s and the 41s. This, just looking at the structure of the volume, is an area of low volume. This is represented and formed on this rally candle to the upside because of how strong and violent the market moved up, not giving the market to have a lot of time there or a lot of volume there, which just indicates large buyers are factored in at this low volume node, and the thesis would then to be watching for a pullback into this to then get long with these large buyers defending price, and we validate the large buyers by this area of low volume, which could be seen on a profile. And this is how I was able to formulate a plan that if the market can dip down into 57.49 to 57.37, if it can hold this, this would be a good area that I am looking to take the market long to target an upside level of supply. So essentially just a sharp pullback into this area of low volume. And even pulling up this screenshot right here on the depth of market, you could still see 57.49 is the start of this low volume. This is how I was able to come up with this range. Well, the market then dips down perfectly into this area of low volume. The volume itself begins to increase, and I find enough confirmation to take the market long on this dip down and on this aggressive move into this area of low volume, which we could still see on the depth of market, having a 4-point stop loss and going for an 18-point target. And here's the sell-off into this range where I take the market long, taking profit at the 65s, which was my target, to make a $14,000 profit or a 4.5 to 1 risk to reward ratio. So being able to validate these areas of low volume. And what I'm gonna do here is I am going to minimize my depth of market as best as possible. And the numbers are not as important, it's just the structure of the volume. We can see here that the structure of the volume, this is the same level that I just mentioned at the 49s, is easily seen as an area of low volume in this range right here. It is the lowest volume so far in the session, and there really should not be low volume as the market is moving up. But what this does is it validates that there's a large buyer present here of the formation of that level. And then we look for a retracement or a pullback into this to get long and follow the footsteps of those large buyers or those large sellers. Okay, so now fair value gap traders, would this be a valid fair value gap? The market aggressively moves up, consolidates. I would mark the box at the lower portion of this wick and extend this all the way down. I'm not sure if fair value gaps just extended to the wick of the rally candle, but in how I trade with low volume nodes, I extended to the lower portion of low volume. So in this example right here, let me know in the comments, is this a fair value gap or is it close to being a fair value gap? Now in this trade, I take the market long as it dips down into this area of low volume. It actually forms a double bottom in this range, and I take profits into strength as the market is breaking out to the upside. This was a $16,000 profit or 3.3 realized risk to reward ratio. Now the thesis for this trade was very simple. What I was watching for was the market to pull back perfectly into this range where it again starts at 61.43 and ends at 61.38, where if it could hold, I would look to play a bullish position. The market sells off, and looking at the depth of market here, we can see an area of low volume, 61.43, all the way down here to the 61.39s is an area where the volume is significantly lower. A lot of people call this valleys and peaks. Essentially, we're looking for the areas where the volume is in valley or it's just not as high as the peaks are. Here we can see the valley is much lower than the peak where we have higher volume. So this at the 61.43s is considered an area of low volume. And this is where I find enough confirmation to take the market long at the 45s, 5-point stop loss, going for about an 18-point target to the upside. Very similar trades. And in the live replay, I was live trading in the investor trade community. The market's gonna dip down into this range right here at the 61.43s. And as it's dipping down into the 61.43s, I just got enough confirmation to take the market long down there, placing my stop loss under the area of low volume. And these other tools on my screens here are just significant other order flow tools to kind of like validate these areas of low volume even better. The market dips down, holds that area of low volume again for the second time, and then we continue to rally up, and I take profits off the table directly at my level of supply. I'm using supply demand or other order flow support resistance methods to kind of put the story together to give me more pieces of information about the market. And this was just a simple retracement into this area of low volume where I take the market long, speculating and looking to capitalize on these levels of strong buyers or large buyers that were present in the market using a volume profile. Now, for all the other fair value gap traders, would this be a fair value gap or at least close to it? The market had a very strong move up. We get this lower wick on the rally candle. A lot of people would call this a gap. Again, this is not a gap. This is just a strong move up. Now, this is a pullback into this, a retracement, is a trade that I was interested in, that as it dipped down into the 59.97s to 92s and held, I found enough comfortable confirmation to get long as the market was dipping down at the 98s, going for an 11 to 18 point target off of only 3 points worth of risk on this day. This was a $15,750 profit, 3.5 to 1 risk to reward ratio. And where this area formed was off of the order flow. Pulling up the depth of market here, we could see significantly higher volume here at the highs, while directly under this significantly higher volume is an area of low volume at 59.98, all the way down here to the 59.92s. This range right here is an area where volume is lower because directly above it is higher volume and directly below it is also higher volume. This is an area in the valley where volume is lower, qualifying as an area of low volume node at 59.98 all the way down here to 59.92. And this was the general range of low volume that we were watching this day. Now, again, if we were just to place a fair value gap, it can be valid, but when we validate it better with an order flow, and I've been using this methodology for many years now without even knowing what a fair value gap was until traders in the community reached out to me and said that this is what it is. But this really is just a piece of order flow that gives us important information. And to see it even better over here, this is just a volume profile, same thing that we saw before. And here's the strong move up. And then here's the area of low volume at 59.98, all the way down here to 59.92, an area of low volume that we look for a retracement into this level, which holds to play a bullish position to the upside. And it could also be vice versa if we're looking to play a bearish position. And this is how I was able to make a little under $16,000 worth of profit. It's identifying large buying or large selling volume, finding ranges where price did not transact much volume at, and this is a low volume node, by price. Volume by price is more significant than volume by time, and then waiting for a pullback or rally into this range for those large buyers or large sellers to defend price. All the examples in this video were bullish, so we were watching for a pullback into it. Not much of this information about volume can be seen off of a candlestick chart alone, which is really why I stress traders to validate this with the order flow. Again, I used this strategy without even looking at a candlestick chart, just simply by validating this with the order flow itself. If you learned anything from this video, I would just really appreciate a thumbs up on it. Comment if you have any questions. I'll go through all the comments. And if you're new to my channel, hit that subscribe button. I would really appreciate it. But on that note, I'm ending it. Peace out. I would recommend everybody to follow me on my Instagram. I'm gonna post a link for this in the description below. It's a really good resource where I basically recap all my trades on a daily basis, and I post really good trading tips and tricks that I guarantee you're just not gonna find anywhere else on the internet. The link for this is in the description below. You're really missing out if you don't follow it.